Buenos días, and en primer lugar, gracias por la noche tan agradable. Realmente apreciamos las hospitalidades argentinas. Now let me read the letter from the Japanese Life Insurance Association, Seiji Inagaki, to brief you about the Insurance Forum Japan. Dear IAIS Global Seminar participants, and thank you for providing me with the opportunity to present feedback from Insurance Forum Japan 2019, which was held on June 5th. 242 people from 21 countries attended this forum. Mr. Jonathan Dixon, Secretary General of IAIS, and other IAIS executives and representatives from the insurance industry discussed important issues roughly. Again, I really appreciate your kind participation at this event. There were 4 panel discussions dealing with some topics such as aging society and resilient economy. These topics are strongly related to insurance industry among priorities for G20 financial track in 2019. At the opening remarks, Mr. Taro Aso, Deputy Prime Minister and Finance Minister of Japan, expressed his expectation that insurance companies have an important role to play in G20 priorities, specifically in addressing aging society and strengthening economic resilience. Mr. Juan Pazo, the insurance superintendent of Argentina, remarked that solidarity is the base of insurance and that we must narrow the protection gap. Mr. Toshihide Endo, Commissioner of the Financial Services Agency of Japan, emphasized the importance of providing insurance products and services which are elderly-friendly. The panelists from utilizing digital technology, considering aging, stated that dividing risk segments into excessively small portions with digital technology would only make the segments inaccurate and volatile and would harm solidarity. For this reason, moderate risk segmentation is necessary. The panel also discussed how useful digital technology is to promote financial inclusion of the elderly and prevention of diseases. There is a need for both the insurance industry and the public sector to work side by side in order to minimize regulatory hurdle. Responding to aging, panelists emphasized longevity and poor health as key risks to the elderly. To tackle these risks, they argued that it is important to cooperate with local communities in health promotion. Health promotion and disease prevention can be achieved by utilizing cutting-edge knowledge such as financial gerontology. Preparation for long life is also important, and in this regard, promotion of financial literacy and incentivizing self-help actions through stable tax benefits system for insurance and annuities should be crucial. It is also important to facilitate a regulatory or supervisory framework that doesn't disincentivize insurers from providing long-term risk coverage. The panel on contribution to building a resilient economy explored cooperation between insurance industry and the public sector, which work together providing insurance for natural disasters. A great example of this cooperation is Japan's earthquake insurance system. Risk management service for small and medium enterprises are also important for social infrastructure that supports the economy and society. Panelists also discussed that it is important to increase investors' rate of return by sharing the increment of tax revenue from infrastructure development between the public and private sectors, and to encourage the private sector investing in infrastructure, as well as the introduction of tools to mitigate investment risk for infrastructure. In the final panel, International Insurance Regulatory Framework from the perspective of aging and building a resilient economy, We focused on aging society and utilization of digital technology. Regarding an aging society, panelists share that too loose regulation could cause mis-selling and harm consumers' trust. However, that strict regulatory environment could impede the ability to provide insurance coverage against aging, such as providing long-term risk coverage and saving products. The discussion concluded that interactive dialogue between the insurance industry and the public sector is important to maintain balance. In terms of infrastructure investment, the panel suggested appropriate definition of quality in projects is necessary to encourage more investment. In regards to utilizing digital technology, panelists touch on the risk of big data and AI. Panelists focused on issues such as black boxing, which shows difficulty to explain pricing rationale and privacy issues and other ethical problems. They emphasize regulation needs to be technology neutral and new regulatory frameworks should be introduced on a risk-based approach. These are my key takeaways from the Insurance Forum. Life Insurance Industry of Japan will provide a summary of discussion in July. The baton has been passed from Insurance Forum Argentina 2018, which convened in the G20 host country of Argentina last September and represented the very first G20 related event dedicated to insurance. You can see now in the logo of the forum this year, we use a traditional Japanese pattern, what we call Seigai-ha. It's a kind of the blue wave, just like a blue wave. This wave pattern, spreading infinitely, conveys the blessing brought to us by the wide ocean and symbolizes both wishes for everlasting happiness and the desire for a peaceful existence of mankind. So what we call Seigai-ha, this blue wave pattern, is thus considered to be good luck. Seigai-ha indicates our wish that this forum initiatives carried on from Argentina continues into future, as well as a concept that insurance serves to strengthen financial safety nets and promote social cohesion. We, Life Insurance Association of Japan, will continue to support this movement going forward. Seiji Inagaki, from the Seiji Inagaki Chairman, the Life Insurance Association of Japan. Thank you for your attention.
I'd like to introduce the first moderator, Mr. John Huff, who's known to, I think, most people in the room. But he is the CEO of the Association of Bermuda Insurers and Reinsurers. With that, John.
Great, thanks. Thanks very much, Connor. I appreciate the invitation to be here from the IAIS and from Jonathan and from Vicky, and for all your work, Connor, that you're doing on great programming this year. So I've been an attendee at the IAIS for several years. In fact, I had one of the best compliments. Peter Kotchenberger, who's one of the NAIC-funded consumer reps that is here at this meeting, told me that my speech that I gave in 2014 at the IAIS in Amsterdam is used in his law class talking about capital. So as things continue to change, sometimes they stay the same. So it's certainly been a pleasure to be involved. This is a great panel for me because Protection Gap has been the bridge, really, for me to go from being a regulator to being back in industry. And I think about how fulfilling my job was as a supervisor and regulator in my work at the NAIC and internationally. But really, the purpose that filling the protection gap can have personally and professionally is so important. So I was so honored to be invited to be at the panel and to help moderate, and we have such a great panel today, and we'll introduce them in just a moment. Some folks have asked that are less familiar with the Bermuda market. I will just invite you to come visit us in Bermuda. It's a great place to visit, 90 minutes from JFK, but the work that the Bermuda market does in the natural catastrophe space is just tremendous. And I'm so proud of we have a small trade association, 23 companies. They are not small in their scale at all. As a jurisdiction that is both Solvency II equivalent and also a U.S. qualified jurisdiction, in the last 20 years, our member companies have paid to EU consumers and to U.S. consumers over $250 billion in claim payments. And that's the way you address rebuilding families and communities after natural disasters. Again, we have a fantastic rock star panel. I want to give them all just a moment to introduce themselves as well. But I'll kick off just to my left, a man who needs no introduction. He brought the G20 Insurance Forum here last year. He brought the IAIS here this year. Superintendent Juan Pazo. Thank you, Juan, for hosting us. I'll let you say good morning.
Good morning. Thank you, John. First of all, I want to thank everyone for being here. It's an honor for us to have this incredible audience. Thank you, Jonathan, Connor, Vicky, and all the Secretariat of the IAIS for the trust that they gave us in order to put together this event. Thank to my team, to Malena Kramer and all the team, because they made a huge work during this week. And I hope that you continue enjoying Buenos Aires, and we could have a good panel here and good discussions.
Great, thanks, Juan. Next is Manuela Zweimueller, who needs no introduction as well. She is the go-to person in Europe and has been such a good friend to me over the years. She and I worked on everything from covered agreement technical work with many long nights to work on Solvency II equivalents as well. So, Manuela, welcome, and if you have any comments, feel free.
No, thank you so much. Thank you so much, John. It's a great pleasure to be here, and buenos dias a todos. Buenos Aires is a great city, so please take some time to enjoy it. Yes, I would like to say that I'm very much honored to be here at the panel with such distinguished moderator and panelists. And I'm looking forward to a great discussion.
And finally, we have Commissioner Gary Anderson from Massachusetts, who's a new member of the IAIS Exec Committee, and just recently he's been named the chair of the NAIC International Relations Committee, the G Committee. So as you think about coming to the NAIC Summer National Meeting in New York that first week of August, that will be his first meeting that he's chairing. We're looking forward to your leadership there, Gary, and I'll let you say a few words of good morning.
Good morning, everyone, and thank you, John. It was very nice, and thank you, Juan, for hosting us. This has been a really incredible opportunity to be here in Buenos Aires. Thanks to the IAIS, Jonathan and Vicky, to Natalia for coordinating our panel today. A lot of work goes into that, and so thank you for doing that and for being such a good moderator. Well, maybe I should not prejudge yet, but it's a real pleasure to be here, although I'm missing my 11-year-old's last day of 5th grade today. But I'll live through pictures, and I will not blame the IAIS. Thank you.
Well, that was a relief. So I promise we'll keep things moving very quickly here. We will use the online tool, so get your phones ready, because we do want to get some feedback on some very important questions. We'll cover 4 main topics if you're writing out an outline. We'll cover closing the protection gap, which is really central to this panel, building resilient economies, investing in infrastructure, and investing in sustainable assets. I will tell you there is something in this panel for everyone, so whether you're in the P&C or life industry, whether you're a regulator supervisor or whether you're a consumer rep, I think this panel encompasses, and I'm so thrilled that the IAIS is going toward some of these new emerging issues to dive in. The first thing we'll do is we'll kick off the critical role that the insurance sector plays in supporting resilience and stability in the real economy. The problem with that is we have a significant insurance protection gap. And for a variety of reasons, it's been stubbornly slow to try to get some movement on reducing that gap between economic loss and insured loss. Just to give you some perspective, and these figures come from Aon, in 2018 we had about $225 billion worth of nat cat loss in the world. Only about $90 billion of that was insured. So it was the 4th costliest year on record of insured losses. But still we had a 60% protection gap. That's, by the way, is the best protection gap we've had since 2005. But 60% protection gap, surely we can do better than that. The natural disasters starting in 2019 have been significant. We're just a few days away from summer starting in most of the world, but really this spring has been brutal by all accounts. It's a stark reminder of our societal responsibilities of protecting consumers from natural disasters. So I'm going to ask all the panelists, what are insurance supervisors and stakeholders doing to help close this protection gap in their jurisdictions? And more importantly, what should the IAIS focus its efforts on to close the protection gap? We're going to start at the far left with Gary Anderson, because surely the U.S. is such a mature insurance market and they know everything, so they obviously have no protection gap in any way, shape, or form. But they did have spring floods this year that hit about 200 million Americans. In some states, the state of Nebraska, the governor there said it's the largest and most costliest natural disasters that have ever hit the state of Nebraska. What's the flood protection and penetration rate in the Midwest? About 1%. So, Gary, tell us what's going on in the U.S. and do you have a protection gap?
No. Yeah, of course we do. Thanks, John. And so, John and I talked a little bit about one particular area where we experienced that. John alluded to the gap that we have with flood. For those of you that are unaware, in the United States, the National Flood Insurance Program, NFIP, which is overseen by the Federal Emergency Management Agency, is the backstop. It's the federal government is the backstop. It holds the risk for flood occurrences in the United States. It was a program started in the late 60s. At the time, flood was considered to be an uninsurable peril. So the federal government is in the business of writing the flood coverage. Some of the recent numbers, late 2018, there was about $20 billion in debt that sits on the federal government's books. This is even after a decent amount of that debt was forgiven. So we've clearly got some gaps. It's interesting, too, in the late 60s, because we experienced kind of in Massachusetts gaps of our own, where there was some urban rioting at the time. The home insurance carriers were unwilling to go into the urban markets. So we have a residual market in Massachusetts that helped to cover that gap that has now morphed into covering more of our coastline. So what was once a gap in the urban environment, there became a bit of a gap on our coast because of wind. So we're attempting to depopulate that, much like, and to jump back into the flood, like Florida has done. Florida has been a leader in this effort, as you know, John, with regard to promoting private carrier entrance into the flood market. Other states like Massachusetts have increased premium dollars on that front as well. So I think the encouraging part about what's happening, though, currently is that, and even over this last week, there have been several things that have happened on the flood front. One is a piece of legislation that the relevant House committee in Congress voted on, which would do a number of things that would promote, one, it would extend and reauthorize this program that helps kind of keep a framework in place so there is coverage, but also promote private carriers to enter the market. And one major component of that, as David Altmaier, the commissioner from Florida, and I were talking about, which he's well aware of, it used to be that if you were insured under the NFIP program and you left the program to go to a private carrier and came back, you'd be penalized. So you no longer would maintain that subsidized coverage. The idea being behind the NFIP, you have affordable subsidized coverage, which of course presents its own set of problems. But that now has been done away with. So you'd be able to leave and come back, which encourages agents to place that coverage in the private market. Another encouraging development was after 6 years, our federal banking regulators have finalized a rule that I think will be implemented in maybe early July that will allow banks to view a private policy much like an NFIP policy. So the requirements to hold coverage if required under a mortgage in the United States. So those are two significant moves in the right direction. Another one that we were just discussing last night was that the NFIP through FEMA will now share years and years worth of data. So that is great for regulators, that is great for researchers, that is fantastic for carriers. We're talking about, I think it's over 2 million claims records dating back to 1978. And it also includes 47 million policy records for transactions from the past 10 years. So you can imagine the kind of data that will be in aiding the private market. So with all of those component parts now in place, I think, you know, as a regulator, what's our role? What's my role on that? And I view it much like we experienced in Massachusetts, for example, when transportation network companies entered our market. So like the Ubers, Lyfts of the world, when they entered the market, there were certain periods during those ride shares that had gaps. But once the legislature and the governor put a framework in place, that is legislation that became law, the carriers knew the, pun intended, rules of the road and came in, quickly priced the gap that existed, and now we have several that offer endorsements to those types of policies. So I view this much in the same vein, where as a regulator, regulators, whether federal or state, in the flood instance, we're now helping to kind of promote a framework that will encourage the private market to step in and fill a gap. The flood insurance program currently writes about 5 million policies, which, as you can imagine, it should be exponentially more than that. So the hope is with now this framework in place, it will encourage more and the gap will decrease.
Great, thanks, Gary. Manuela, just saw the headlines this week. Munich got hit pretty hard with some hail. That was pretty impressive, but the estimates are already coming in, maybe 400 or 500 million euro for the insured losses. I suspect there's quite a bit of uninsured losses there. But tell us generally what's going on in the EU.
Thanks, John. So after John pointed out that there was a hail in Munich, I immediately started to search in the news. There was a big hailstorm in '84, which was about, at then value, 750 million euro, which would correspond to 1.2 billion today. So that was by far the biggest hailstorm and caused by far the biggest losses, in particular on motor insurance and casco insurance in the region of Munich. So thanks for pointing it out. So protection gap. We heard the debrief from the G20 Insurance Forum in Tokyo, which was a real great event, and in particular an eye-opener with regards to aging. I think here and the IAIS will pick up the topic of aging. So we not only have protection gaps on the natural catastrophe side, we also have big protection gaps on the pension side. So to really get a decent retirement savings of which you can live from. Also on the health side. But today we will focus on the nat cat. But the IAIS will also look into aging, which is great. The protection gap is widening, so the latest figures from Swiss Re demonstrate that for the first time it's really outpacing, so the growth rate of economic losses calculated over a 10-year rolling average is outpacing the growth rate of the insured losses, 5.6% versus 4.5%, something like this. So you can imagine if this continues like this, we will have a real issue. to. And they refer in particular to secondary events, which play a more and more important role, in particular also triggered by climate change. Yeah? So they will really also evolve, and we need to watch out for this. We, at EIOPA, have recently entered into a debate with our board on the protection gap. And we will continue to also engage with stakeholders on this. With this strategic paper, we also started to look into what is the situation in Europe. And we also tried to find some figures, in particular also for individual countries, and only came up with, really, to be honest, very old studies and indication. So the situation is really a patchwork. So it really depends on, there are different perils which play a more or less role in the different member states of the European Union. It also depends on the exposure. For example, Holland, the Netherlands, and that I think is known to everybody in the room, is highly exposed to flooding because they're really underneath the sea level. But they also have the expertise in building dams, and so really also help to mitigate risk and have risk adaptation measures in place, as an example. We also looked whether there are, what is the insurance penetration, highly different, also completely different for the different perils, including also the government backstops. So we have different constructions. For example, in Spain, we have the Consortio for windstorm, which has a parametric trigger. We have the CatNat system in France. So I think our first task is really to get this very detailed information, to do a mapping exercise, and being also reminded that we also have been, Europe has been hit by severe events more and more also in the past, I would say 5 to 10 years. So we had the hottest summer in Frankfurt last year, the hottest summer in Frankfurt, 35 degrees, also not really cooling down in the night. We had in 2016 the floods in Paris and also the floods in Lower Bavaria. In a very small city, only having 10,000 inhabitants, but the whole region was flooded to such an extent that overall 50,000 were affected. The damage was 1.2 billion. Not much was insured. The EU had also to open their funds to help finance the rebuilding and also to put in place mitigation measures, in particular to get the river more under control. So this is the situation. It's very serious. In addition to the mapping exercise, we will also enter into different roundtables with stakeholders, ranging from academics to public institution representatives, also including, of course, World Bank, including industry, reinsurance industry modelers. So we will reach out very, very broadly to have a serious debate. We will also raise awareness amongst politicians because we did some calculations how such not insured losses could affect government budgets. So would there be a risk to financial stability? I think this is where politicians definitely should become aware of. Access to data, because as I said, it's difficult for us currently to get data. This is another initiative in this overall framework, that we get more data, better data, a higher quality of data, but also in particular to push and to move for giving access, in particular for public institutions, to already available data, and also moving into the direction of open source modeling. Because I think such publicly accessible models could be very helpful for public institutions and then for the broader benefit of the public. So this is, in a nutshell, quite a big initiative that we are trying to pursue during the next 2 years.
Thank you, Manuela. And Manuela raises a great point of what happens when you have your protection gap growing, or who picks up the tab. Well, of course, it's the taxpayers that pick up the tab. And the most impressive statistic that I have seen, that for every 1% improvement on the protection gap, or 1% improvement on penetration rate, I should say, for insurance coverage, saves taxpayers 22% on a natural disaster. So the real economic driver here is shifting the risk to the private sector through insurance coverage, increasing that insurance penetration rate, and then saving the taxpayers on the back end. So Juan, let's hear about the emerging markets. Sometimes people think that the protection gap's only in emerging markets. I think we've proved that wrong with our first two speakers, but tell us what's going on in your market.
First of all, I don't know if I'm relieved after hearing Manuela and Gary, because I believe that at the end of the day, we're facing the same problems. We have protection gap in the agricultural business in our country. We have a huge protection gap in the pension and life insurance business in our country. So what we believe is, as supervisors, is that we have the responsibility of paving the way and removing obstacles for closing that protection gap. We believe that that is one of the better ways to improve the quality of life of millions of people, at least in our countries. In our country and in the region, I believe that the main reason for this gap it's wider. It's the lack of social and financial inclusion, and it's essential for the state to provide the tools for the greater financial inclusion. Our experience in Argentina is we created the Financial Inclusion Council 2 years ago, depending on the Minister of the Treasury, where lots of the agencies are working together in order to make the population to have access to to financial tools at all. When we started the government in 2016, The Economist issued a ranking in the global microscope, and we were like 44th in the ranking. Right now we are 9, but that only talks about the framework and the legal provisions. We have tons of law work to do in order to the insurance industry, the banking industry, fintechs, try to allow people to have access to financial industry at all. That's our main challenge. When people have access to financial instruments, to the financial access, then we can start talking about the reality of insurance. What we have done from the SSN, first of all, we have issued a resolution establishing the characteristics of microinsurance should contain and the precautions that insurers must have when selling the new products and carrying our financial education promoted by SSN. We believe that that was one of our key roles, education, working together with the industry in order to tell population which are the new products that are available and facilitating the industry to provide this type of products. On the other hand, the lack of development on retired and life insurance in our country, it represents a huge gap. It's enormous. The premium penetration of life and retirement, it's only 0.6% of our GDP, when in similar countries of the region, it's more than 8. We have more than 44 million inhabitants, and less than 4 million had any kind of life insurance product related at all, even related with banking accounts. So you could see the protection gap there. It's enormous. In order to close this gap, and more recently, our President Macri, fostered by the Superintendency, updated the tax deductions amounts as an incentive for savings in life insurance and retirement plans. We believe that perhaps this is the first step in order to develop this market, that it's so important for us. The new regulations mean a fundamental change for the insurance industry and the insurance market, at least in our country. We know that when we are suffering fiscal restrictions, sometimes the industry asks the government to provide type of subsidies or tax deductions in order to develop this type of insurance, but it's really difficult when you're on fiscal restrictions. That's why we still have a huge challenge ahead. It's the developing of agricultural insurance. The primary agricultural activity represents 18% of Argentinian GDP. When a catastrophic event happens, as last year, the losses are huge. I believe that last year, the drought that was the worst in the last 70 years impacts in a law of collection to like 4% of the GDP, $9 billion, and that was part of our huge crisis. There's also an economic loss for the producers, and we have problems in the next year because they don't have the amount of money in order to continue their operations. And that gap could be solved with the development of new products, again, catastrophic risks, because today only 2% of the land, the planted land, is insured. But we need to be creative because we don't have any type of subsidies or possibility to make a cat bond. So we invite the industry and we are participating with them in order to develop new products that could solve this issue.
Thank you, Superintendent. I thought I'd just take a moment to make sure folks were aware of, introduce you, if you're not, to the Insurance Development Forum, because they've laid out the issues and the problems and challenges we have on protection gap, but I want to tell you where at least some of us are working in terms of where can we work together to find the solution. And we're putting a lot of energy, ABIR and their staff and companies are putting a lot of energy in the Insurance Development Forum because we feel like they have the formula that can help address some of these issues. So just real briefly, if you haven't heard of the Insurance Development Forum, I encourage you to learn more about it, get engaged. They're really off the ground and running now. They had some governance issues initially in terms of how to structure, which was very important, and now they've hit the ground running, and I'm excited about some of the work that's happening there. It's really an unprecedented public-private partnership with the insurance industry, the World Bank, and the United Nations, and there's quite a bit of room for opportunity for everyone to participate. This is not something where you just join and you pay and then you're part of it. Anyone can be involved, whether you're a sponsor or not. Their goal is simple: to reduce the protection gap, particularly with the climate issues that we have, and you'll see some more detail there about the sustainable development goals. The 5 steps there, if you will, the insurance sector, governmental and other international institutions, coordination, shared priorities, resources, strategic and operational relationships, and integrity and effectiveness. This is a group that, to be honest with you, many groups have their communication get ahead of their substantive work. This is a group that's doing very substantive work, and the reason I'm sharing this with you today is because I think they now need to get the communications caught up with some of their work that they're doing. This tells you about this public-private partnership that's led by Kiko Honda from the World Bank. Denny DeVerne has just taken over the industry role from AXA, which is, he's doing a great job. Initially, the industry leader was Steve Catlin. Many people in this room know Steve Catlin from XL Catlin. It was very engaged, and I suspect he'll re-engage on this issue. The group is being led by Denny DeVerne, and then Achim Steiner from United Nations. Incidentally, Steve Catlin has just announced a $1.8 billion largest startup affirming the Bermuda and London market domiciles for reinsurance. And so we're interested in watching that company grow. He corrected me the other day. I said it's the largest startup in Bermuda's history. He said, no, John, it's the largest insurance startup in the insurance sector's history. So it's interesting that in this environment of reinsurance, we're still seeing companies form with a great deal of investment opportunity there. And then you'll see some of the companies that are involved and organizations involved in the IDF. And here's something to watch for. So look out for this September at the United Nations Climate Summit. There'll be some significant announcements coming from the Insurance Development Forum talking about capacity for climate risk insurance at the sovereign and sub-sovereign level over the next 5 years. And this is the most exciting project I think they're working on right now. It's a risk modeling alliance, which is essentially like an open source modeling for emerging markets that have never been modeled by the insurance industry. And how can the industry, the World Bank, and United Nations work together to do some modeling there, not for the sole purposes of selling insurance products and creating insurance products, but also to use that modeling then for environmental and development, construction, zoning purposes in those countries. So I share this with you just as a teaser for you to get more information and to be involved. So thanks for letting me have that opportunity to share that. We're going to switch a little to, I want to take just a fast poll, and so we'll pull up the polling tool. And really the question is, should the insurance sector be equally concerned about closing the protection gap, or should they be concerned about closing the protection gap in which markets? Developed or mature markets, emerging markets, or both? And while you're answering the question there, I'll turn back to the panel and see if they have any initial thoughts about the Insurance Development Forum and how the IAIS and local supervisors might be wanting to be involved. So Manuela, maybe we'll kick off with you.
Thanks, John. As I said already, I think what is important is really a collaborative effort, yeah, so that more or less we need all work together, and we need to reach out to each other. So, and also involving, initiatives such as the IDF, insurers, reinsurers, the industry, those who have the expertise and the knowledge. On the other hand, also academics who could provide new and innovative thoughts how to deal also with, the protection gaps and modeling in particular. Including, of course, the supervisory community, which is very, very important to have this dialogue. And the IAIS is really very, very much, and you will hear it in the next panel, which Jeff will lead, is very much engaged in topics such as sustainable finance and also climate change. So I'm quite sure that also there will be a reach out also in the future to a diversity of different stakeholders.
So some of the initial numbers are coming in. If you're in the political business, you'll say we've been doing push polling all morning. We have pushed you to the, hopefully, to something you probably already knew intuitively, a large response there for both sectors to be involved in addressing the protection gap, but with a strong showing that there needs to be addressed in the emerging markets. Gary, any thoughts about Insurance Development Forum and where you see a role for supervisors?
Sure. So I caught the poll. It seemed like it was both, right? To be concerned about both, which is probably wise and prudent. Interestingly, as I was thinking about what Juan was talking about, what Manuela was talking about, and kind of penetration, particularly in some of the emerging markets, we've seen some encouraging development, or positive developments on coverage in emerging markets. I think from 2005 to 2016, let's see if I can find my stat. The developed nations represented 88% of the insurance coverage. That's now to 67%, which seems to suggest that over the course of 2005 to 2016, that there has been penetration into emerging markets. To Juan's point about, as the regulator, the difficulty about, part of this is education and getting products to people, and we're not good at that, really. That's where the private carriers, private market is sophisticated and good at that. I think with innovative approaches that we've seen over the last several years, people literally have now that capability in their hands, from both startups, from InsurTech, but also partnerships with large carriers. So I think all of that, the confluence of all of that, has helped to kind of drive more penetration.
We're going to switch gears a little and talk about building resilient communities. And I always say you cannot talk about resilience without talking about reinsurance. And so there's a great example here that I heard Juan tell the story of Argentina last year at the G20, and a very bold step that the regulator, the supervisor, made in terms of opening reinsurance markets. I'm also going to highlight a comment that was made yesterday at Exco. I think Robert Neal stood up and talked about a new group that's forming, the Coalition for Reinsurance Education. We're proud sponsors of that group as well, ABIR. And they've just sent a letter to the IAIS. I flag it for you because there was some positive response yesterday from Exco, and it's an area that really goes to what we're talking about this morning. But I did want Superintendent Pazo to talk about his reinsurance experience in Argentina and how it changed the market for him.
Well, I remember the first day we assumed with the Deputy Superintendent, Guillermo, and we look about all the reinsurance regulation, and for us it was unbelievable that it was still closed. When we start working together with the industry in order to put in place a new regulation, lots of companies, journalists, tell us that the world would collapse, that the whole insurance industry would have enormous problems in order to fix this. But at the end of the day, I believe that those was the most important regulation that we have made since we were appointed. We reopened the insurance market. We started gradually, but really, really strong at the beginning. We opened it gradually, but we opened it totally for risks that were over 30 million for catastrophic risks. So that was a huge decision. Our new regulation reopens insurance gradually. It allows to increasingly reinsure internationally along a period of time. This had positive effects on the market in terms of pricing and access to insurance products. Insurers were only able to conduct active reinsurance operations with Argentinian reinsurers. There was an emerging market with most of the reinsurers operating as brokers, allocating risk in admitted reinsurers, but only holding the portion of the risk established by law in our country. This way, the reinsurance agreement became more expensive, and so they did the insurance agreement. Since the new regulation, Argentine insurers can subscribe greater risks in qualitative and quantitative terms, considering that the international economic capital provided by international reinsurers provides the necessary support to assume risks that could not be assumed with a closed market. As previously stated, what happened with these risks is that the way they were reinsured in Argentina, but that the local reinsurers necessarily have a retrocession of those risks abroad, was only a brokerage fee. And what we believe is that the only purpose of that, it was a measure of control over the flow of foreign currency abroad and some side business. Because at the end of the day, you have the key to order which, when you have two types of currencies, perhaps some person have the key in order to decide that flow of currency at a lower price point. So for us, it was a huge task because we have several infrastructure projects that couldn't not be carried out without the reinsurers to cover those risks. And as we are on an enormous infrastructure plan, and we have huge developments in Vaca Muerta, in Neuquén, due to shale gas, and we have enormous projects in the northern part of Argentina regarding lithium. Couple of those projects couldn't be developed without proper insurance. So I believe that it's a story of success on how we could work all together, how you diversify risk. And for us, it was the only way to play again in the world map.
Thank you, Superintendent, for sharing your experience. And I think it's telling for all of us when we identify areas where there may be protectionism, if you will, in trade or regulation or tax, of not being able to spread risk internationally. And it's so important for the insurance supervisors as they build their regulatory regimes to give confidence in markets that the safety and soundness of spreading that risk internationally. But beyond reinsurance, I just thought I'd raise the issue, and maybe Manuela, you can give us a sense of what the insurance sector's role should be on disaster risk prevention or even mitigation, and what's going on in the EU and in those areas as we address some of these disasters.
So I think what is very, very important is the expertise and the knowledge that is really collectively available, in particular on the insurance side. Yeah. So you have seen the claims, you have dealt with the loss adjusting, you have also tried to increase resilience to such disasters, and you also have these analytical capabilities, to do not only the modeling but also to find out out more or less where would some kind of risk mitigation also make more sense, because it also depends. You need tailor-made products for the different market. So where I would really see the benefit from the industry to help close the protection gap is to use this expertise and experience, to use the risk management capabilities, and also to more or less open up this expertise and knowledge and share it also with those who really also are in need for it, in particular in the emerging markets. So public-private partnerships would much benefit from such exchange of expertise and experience. So this is where I see a big role, and of course with regard, if I think about pricing and underwriting, so that can already be an indication for incentivizing adaptation that was done. For example, if I built a higher wall, for example, if I try to get the little river that is across my garden under control and things like this. So I think the pricing should incentivize risk mitigation measures taken. Plus, of course, I think the industry can certainly also push for such measures to be put in place.
Thank you. And I think finally we'll shift to sort of the asset side and talk a little bit about infrastructure and the resilience needed there. And I think we'll take a panel question here and just talk about the role of supervisors and regulators on infrastructure. If we can put up that polling question. And my guess is we're going to have some purists in the room here who think there's not a role for regulators to play in building up infrastructure, that they think there's just a role for safety and soundness. So while they're teeing up the question, I'll just read it to you. Should insurance regulations support, deter, or be neutral regarding infrastructure investment by insurers? It's so important in building a resilient community, resilient economy, to have a strong working infrastructure. So this is the question: support, deter, or be neutral? And then as we're waiting for those questions, those answers to come in, Natalia, I'll just check with you on time because we're off schedule a little bit because of the G20 comments. I just want to make sure we know where we are. This clock says 35 left. That's not right, though, is it? It is right. Okay. We'll take every minute of it. So this is interesting. I'm interested in the panelists' thoughts coming in here of whether regulations should be supportive of infrastructure investment or should they be neutral. Any initial thoughts, Gary? You have to use your microphone, Gary.
Maybe I didn't want people to hear me. So my initial thought is there was a discussion yesterday at Exco briefly about this, and it was noted that that we're kind of in the midst of gathering data to help in this in this regard. And I guess that takes me back to an earlier point, and maybe it's a bit of the theme that I will play by during our panel, which is, as the regulator, I do view it as our role to help establish reasonable and flexible frameworks that encourage or incentivize. And what was indicated yesterday was the development of data sets to aid in this effort. I think that's helpful for everyone, for both the public and the private side, so that we kind of have barriers and rules of the road to play by. So I think that would be my initial kind of response to that. And I'm not surprised. While somewhat different, I mean the support in the United States through bonds and the from the U.S. insurance carrier side of things and the support through the bond market does a significant amount of good, whether it's building of schools and roads and things like that. Now I know this is slightly different because we're talking long-term infrastructure investments directly, but so yes, that's my immediate thought. I think it's helpful to have kind of the rules of the road.
So Manuela, when they took the numbers down on us, but I saw the one that just barely had any was deterring infrastructure investment. So I know some people talk about Solvency II and the review. There you go. There are the numbers. So almost no one said that the regulation should deter infrastructure investment. But as you look to 2020 and the tweak, if you will, of Solvency II, is there area for improvement there, or where do you think that might go in terms of infrastructure investment?
So, first of all, I would like to say that infrastructure investments are, of course, also ideal to match long-term cash flows that insurers have on the liability side. So that we see definitely as a benefit, and this is also where the Solvency II framework gives incentives for. The 2020 review, which is focusing on the long-term guarantees, will not pick up the infrastructure topic again, because we have done work on 2015 and 2016, which has recently also been legislated, so that means to put into law and published also in the official journal. So here we did a lot of work with regards to infrastructure projects, so that means loans, and also infrastructure equity and debt. To this regard, so we started with defining what is infrastructure, because there are debates already about, okay, whether utilities should be considered as infrastructure, for example. We had long debates about telecommunication within Europe. So that's the first thing. So what is infrastructure that's needed? The other points are then, okay, what enables insurers to have safe investments, so that at the end of the 40 years or 50 years, there is still, not a disaster, let's call it like this, because not every infrastructure project goes well. The World Bank did an enormous project also in the last 2 years, and could also demonstrate that recovery rates for certain projects are better and above average, but it's really for a limited part of the projects. This is why we also developed criteria and safeguards, and really focus a lot about risk and evidence-based infrastructure. This leads also to what Gary said, data. They are really important. The risk management capability in the firms also need to be there, or these capacities need to be built. If you outsource to an asset manager or to a reinsurer, be sure that you understand, and that your investment committee also really understands what they are investing in. And then we have additional criteria such as what is more or less what a bank also would look in investments for due diligence, for example. Predictable cash flows and stable cash flows are very, very much important. Or, for example, that at least you have a right on the asset should things go wrong, so that at least you can try to sell it and get some money back. Also contractual issues are really important, that you're really first in line if something goes wrong. So these is more or less also all these safeguards around it. And I would like to emphasize again, so we in Solvency II have the prudent person principle. We don't have limitations on investments. So it's really all about risk management, and this is also the philosophy that we are putting into the 2020 review. The IAIS will embark in an infrastructure project, also on the basis of what the World Bank has explored so far. And we will have a roadmap over a certain timeline, which will most probably encompass 2 years. But I think it's really worth it, because we will start with the data. We will start with the mapping. What are the regimes in the different jurisdictions around the world? So this is the fantastic platform that the IAIS gives here. And secondly, we will really look at data sources. Because that is really important. And then whether there is a differentiated treatment justified or not will really be the third question. First, we need to get basis right.
Thank you very much. And Juan, you gave such a compelling story about the impact to your market, opening reinsurance to international and global markets. I'm interested in your thoughts of the role of insurance regulation, either supporting or hindering infrastructure investment, and what your experience has been here.
Well, my first thought is that I believe I told you we don't tip the audience to vote for our perspective, but when we were talking previously about protection gap. In lots of our emerging countries, we need to talk about infrastructure gap, and we have a huge infrastructure gap. Perhaps we don't have the type of discussions about which type of investments are infrastructure or not, because our needs are so huge that almost any of the assets that we are talking about have known any kind of discussion that they are infrastructure. And then I believe that it's important what the G20 is trying to do in order to make an asset class of infrastructure, in order to gather data and how the way of these plans are structured. Because lots of times we have this type of discussions and we don't realize that perhaps locally in certain countries putting charges on infrastructure investments has no sense at all. Because for us, perhaps they are safer even more than our own treasury bonds. So the discussions might be really important on a global level, but also on a local level. For us, insurers are the main institutional investments at a global level, are a really important institutional investment investor at a local level, and they could participate actively in the acquisition of assets related to infrastructure. For that reason, we believe that regulators must establish a list of investments for the capital and coverage calculation, which includes the possibility of calculating assets related to these matters. The SSN, our unit, rules the possibility of insurers to invest in infrastructure funds in general, but in particular in those funds that intended for productivity, which have an impact in real economy, in growth, in resilience and sustainability. Also, we worked a lot in order to understand how these products, these financial products are structured. Because in our countries, right now, we are developing the most ambitious infrastructure plan in the last 70 years, and we need institutional investors to support this plan. So for us, this is one of our key roles at this moment. And the kind of insurance that we need to enable in order to make these plans also was the first demand warranty by individuals that provide protection for contracting with the public body. And why was this so important? Because as their PPP projects are structured in Argentina, you don't only have the warranty of the state, that it's independent of the treasury bonds. You also have the warranty of the contractor. You have the underlying asset. And above that, you could have this first warranty or a standby letter of credit. So when we are talking about which is the type of not only of yield that these projects give you, you could also see that you have a lot of warranties in order to support this type of plans. Perhaps in emerging markets we need to be creative because our needs are huge. And I believe that our role as regulators is to try to understand the needs of the country, understand the needs of the industry, try to match the liabilities of the industry with the type of the investments, but trying to look deeply on the products in order to understand which is the real risk, which is the real contribution to the economy, because when you need growth and sustainable development, you need to have the insurance industry as an investor participating actively. In our country, we need to develop, if we want to grow like 2.5% a year for the next 5 years, we need to almost triple our financial market at all. That is impossible without the participation of the insurance industry. And we need the participation of the insurance industry also as an institutional investor. lots of governments are tempted to, at least in the region, to take the money of the insurance companies to buy bonds of the country or local bonds. And we believe that it's much more safer to structure real programs, private and public infrastructure plans with lots of warranties and that are really structured in order to fit the liabilities of the insurance company. And we are going to support that. The role of regulators in this case is to design the regulations that are conductive for infrastructure investments to be computable for insurers in terms of capital and coverage, and interact with the industry to design the ideal investment instruments that are useful for the development of economy. We are working a lot with the life insurance industry in order to put this together. And another thing, I believe in dialogue. We need to work together in order to understand which are the projects that the insurance industry needs, and then go to the financial markets and to the government in order to put them in place.
Thank you. Let's tee up the next poll question, and I think this is going to be one that's very interesting for us to feed back to regulators and supervisors, because what we saw in the first poll was a stronger support for regulatory regime to support infrastructure, at least be neutral. It was almost flat, but a little stronger on the support. What we heard is folks are not opposed to that. In fact, some things we should encourage it. So why isn't this happening? What is the main factor that currently prevents insurers from investing more in infrastructure? Is it simply their just lack of appropriate projects in the pipelines, and that may be political obstacles? Certainly there are some in the U.S. that we can speak to of where there's not enough political will to develop an infrastructure plan. Or two, is it overly high price in terms of capital charges and the solvency regimes? Or three, are there non-capital regulatory burdens and regulatory obstacles? So I ask you to cast a vote here, because I think this is one we're going to share. Uh-oh, I see 4 options there. I better turn around and look. Okay. There it's growing with just under 50 respondents. This is one you're going to want to take a picture of before you leave when this is ended, because I think this is going to drive the discussion, or should drive the discussion of what needs to be done in terms of jump-starting infrastructure. I'm seeing a growing lack of appropriate projects in the pipeline and fairly high, overly high capital charges. So that's one where the regulators, I do think, need to do a deep dive and to scrub there to see is there something there. Also, some rising on non-capital regulatory burdens. That would be interesting to tease out of that. What's happening, and then a nice fat all of the above for folks that stayed out too late and just wanted to hit that button. And then I don't know what the none of above are what they're thinking. But this, we're at 90. That's a pretty good response. I don't think we've breached 100 on these responses since we started this polling. So still lack of appropriate projects in the pipeline. That tells me this is more than a regulatory issue. That's not to say that regulators and supervisors can't be involved in the larger economic discussion, but I think that's very telling of where we are with infrastructure. We're going to shift, just be cognizant of time, because this is a continuation of infrastructure and really talking about investing in sustainable assets. And we promise not to step on the turf of the next panel that's going to talk about some of the sustainable and climate action issues on terms of disclosure. But as long-term investors, insurers they're certainly well positioned to invest in green or sustainable assets, which may require some longer time horizons. And like infrastructure, there may be some regulatory burdens there. And we keep hearing the new buzzword of ESG, and environmental, social, and governance, and those factors, and should those be considered in the risk management framework of insurers? Or should the regulators really be back to that neutral stance of looking at the safety and soundness of the organizations only? And I'm going to ask Manuela if she'll kick us off here just to give us some perspective of this ESG trend. I think my own personal opinion is everybody has a different line of where they think some of these factors maybe should contribute on the regulatory side, but I'm interested in getting what the EU's doing and how they're looking at it.
John, thank you so much. But if you don't mind, I would like to give a quick response on the result of the infrastructure question, because we had a lot really on the project and then also on the capital charges plus a combination or the other burdens. So on the other burdens, what we have got as a feedback is really political risks and regulatory risks. Yeah. So for example, if you enter into solar panels that give a certain output, and then you get a certain a certain amount of money, if you feed it into the public electricity, and if that suddenly changes, you also won't, you will have difficulties with the return on investment. Same with bridges, and toll over the bridges. So here, stability is really also needed. Then the structured and standardized product. That was already said by Anna-Maria Dulster from the Geneva Association in Bariloche last year. Yeah, so there are not sufficient structured and standardized infrastructure projects, and also securitization would help a lot. So I think that is really also a signal, and I know that the European Investment Bank is now really heading for this, and also for establishing funds, and also to allow for co-investment. And this is that goes in the direction what Juan said. It's really about providing guarantees and facilitating and enabling. So I think this is really where the EIB can be of use. I don't know whether you also wanted to say a word on the okay, because oh good, then I go to the question. Sorry, John. The question on ESG. So ESG, it's not so overly new, but I think it's now more pressing. And this is why I'm extremely happy that this debate now gains momentum compared to really 20, 15 years ago, where a lot of companies had sustainability departments, and then at the end, they were closed, or the things were, sustainability reports were published that did not have so much content. So this is a great opportunity because I think we are all responsible for our planet. So we only have one Earth. And this is really as individuals sitting here and in the audience. From a regulatory perspective, if I think about Solvency II, Solvency II is a risk-based framework. So Solvency II already fosters also to take into account ESG risks, for example, in the ORSA. Because the ORSA is a forward-looking perspective, so you need really also to think about such risks that may manifest themselves in the future. The second point is, for example, forward-looking modeling, which is very difficult. I know about it because it's still not completely scientifically proven in some cases in which direction the climate change will go. So it's very difficult to factor this in, but I know that some of the model vendors already think about these forward-looking aspects. That's good. So these are two aspects, but in general, what is really important is that insurers, it's for themselves and it's for their own financial stability, that resilience, that they also consider the investments in which they invest, whether they are affected by ESG. Be it environmental, we focus a lot currently on environmental, but it could be also social and governance factors, and that could impact, in particular the governance factor, could impact a lot on the reputation of certain companies in which you may have invested it. And we see it recently really in the shareholder meetings, the pressure on different topics, be it modern slavery, children's work, things like this, is done. So here is where the G and the S are also linked. So it's in the own interest of the companies to take these risks into account and see, okay, which kind of investments they are invested in, and is there a transition risk? So will these investments depreciate or change value over time because certain risks, and in particular climate risks, will evolve? and manifest themselves. And the other thing what we are very much supporting is really the stewardship principle. So that means we see here really a role and a power of the insurance and reinsurance industry to engage with their clients and to give them a nudge, yeah, also to go more into the direction of being more sustainable. Because I think this goes then also back to underwriting and pricing. The insurers and reinsurers anyway need to price and underwrite according to the risk. And this risk should certainly also involve, okay, in which direction will this go and in which direction will it evolve. So the stewardship principle is very important for EIOPA because we think here we can really make a major impact on overall.
So Gary, tell us about the U.S., these ESG factors. Should they be incorporated by the insurer? And then even take it a step further, should there be some prompting by the regulator?
So again, I think it seems like to me anyway, a theme from the last topic and this one is, as Manuela was just talking about, the modeling component of that. And as Juan was talking about, the understanding the true risk. Right, so with both of them, that seems to be, to me, a similar theme. So, and risk is different, to Juan's point. Understanding risk is different from jurisdiction to jurisdiction, and measuring the risk is different. So I would say, one, understanding the real risk, and two, understanding, as Juan and both Manuela pointed out, the contribution to the economy. I think too, I would say that, I guess I'm backing up a little bit to the prior point because I took notice of the graph that it indicated if there are impediments in jurisdictional impediments to infrastructure investment. Certainly there are differing views on the current ICS and its potential impact on long-term investments, long-term infrastructure investments, long-term guarantees. So that's of particular interest to the United States, of course. Even in the United States, as I've heard, there are some impediments in our current solvency framework that may be some barriers to infrastructure investments. I think really, again, it goes back to kind of the setting up the proper framework, and that includes data, and the modeling, understanding the risk. I think a plug for the NAIC and our QSIP database, understanding, as John and I were talking about last night, understanding the risks that are on the carrier's books through that process. I think through the NAIC, we've got a very good handle on what they are investing in and the type of risks that are posed from those investments. So again, I think from my perspective, it's again setting up a framework and making sure that we have the data that supports that framework to incentivize if that's the direction that a carrier wants to go, and understand the real risk and we understand the contribution. I think that's kind of the starting point for me.
Thank you. So fair warning, we're going to take some audience questions in just 1 second. I'm going to ask Juan about his thoughts on ESG and his approach in his jurisdiction and his thoughts generally. But we'll take some audience questions, so if folks will get ready for those, we'll be happy to open it up. So Juan, do you have any comments on the ESG movement?
Yes, we're working together with our Security Exchange Commission in order to put an asset class of sustainable investments. We are in the first steps. I believe the Deputy Superintendent had a meeting yesterday, and it's having a meeting today with the CFOs of the local insurance companies in order to put together this type of products in order to the insurance companies to invest, because we noticed that lots of companies are already investing in part of their portfolios in SEG investments.
Thank you. So any questions from the audience? Question right up front here. Either side. If you'll introduce yourself and your affiliation, please.
Morik Fulala with Fulala Consulting Group. Manuela mentioned an IAIS project on infrastructure, and I'm wondering if we could hear a little more detail about that.
Thanks, Morag. I think I said everything that is known for the moment. I also got permission from Jonathan beforehand. So we are embarking in a project on infrastructure investments, also as a loans and equity, that's both. We will do first a mapping exercise of what is already there in the different jurisdictions, which are member jurisdictions of the IAIS. Secondly, we will go to data sources. So or their data sources may be that some regulators have used or industry have used, we are not currently aware of, because we are putting a lot of focus on the World Bank data. The third step will then be the consideration whether a differentiated treatment is justified or not. So it's really very logical step and sequential project. So my guess would be that it will take around 2 years overall, because of all these data search and investigations. So that's the current status quo.
Thank you. Is there another question? I think we have several here.
I'm Callum Tanner with the Association of British Insurers. Just the first point, I think it was mentioned that infrastructure should always be risk-based rather than looking at some kind of deal with politicians. It should be based on data, of course, rather than just thinking about trying to get more projects off the ground by giving insurers better regulation. So thinking about data, I guess, in current regulation, for example, Solvency II, you can see that the risk of climate change, both on the asset side and the liability side, doesn't perfectly take into account the risk of climate change. For example, Solvency II requires more capital to be held against corporate bonds, which are often more carbon intensive than green infrastructure projects, such as wind farms. So I think that may be an important issue to consider in the 2020 review. Obviously, it has been considered before, but the specific climate change element hasn't been considered. So I'd be keen to get any thoughts, I guess, on how Solvency II could change to better recognize green infrastructure and also the ICS. Thanks.
Manuela, I would turn to you unless you want Gary to make something up on Solvency II. So.
Please, go first. Okay, I'm very sorry, the acoustics, I have a little bit problem to understand, but I understood the question like this, that more or less, infrastructure is long-term, and long-term is in the 2020 review, and so something needs to be done. Was that a little bit the direction? Okay. In a nutshell. And then you also talked about the ICS. So I start with the ICS. As said, we have this project set up, and once this project will bear fruit, and this is why we do it in parallel to the monitoring period. Yeah. There is definitely the possibility to feed in the results. Yeah. So this is why we decided also to start it, to also have it during the monitoring period. And then we will see whether differentiated treatment is justified or not. And then it can still be fed into the PCR at the end of the monitoring period. Solvency II, as said, we did quite substantial work in 2015, 2016, 2017 it was published. What we are also doing is on illiquid liabilities. Yeah? So I think that is the link to infrastructure, which may trigger also the question. We are also doing a project, I think, since the EIOPA conference of end of 2017 on illiquid liabilities, and how the illiquid liabilities can be matched by equally illiquid assets. And here, of course, investment in infrastructure would be also a choice to be available. But that work is still going on. So I'm just thinking, when will we issue the consultation paper? I think after the summer break, yeah? We will issue the consultation paper and also our thoughts on illiquid liabilities, and, for example, also a very simple individual company illiquid, equity holding period test. We don't call it liquidity test. It's avoid confusion with macro, but it would be an equity holding period test. So that is also one of the ideas that we are currently considering. But as said, there will be a consultation paper issued, I think, around the summer break.
So I think we have time for one more question. I think there's one over here.
Hi, I'm Bernie Birnbaum with the Center for Economic Justice, a consumer organization based in the U.S. You all have spoken about investments in infrastructure as a way to promote sustainability and resilience. There are growing examples of insurance companies entering into partnerships with individual policyholders for loss mitigation, for example, vehicle telematics and some home sensor devices. But so my question is, well, what are the impediments to broader investments by insurance companies into physical loss mitigation with their policyholders, and what types of activities or initiatives are needed to overcome those impediments?
So I'll look for panel volunteers. So, you know, I might rephrase or recharacterize. So we saw some of that with the auto industry, right, where you creating ways to track whether you're a good driver or not, and so the ability to tell people where they are in the risk or limit how they're driving. And so that would be an example in auto market, but I think talking about resilience and protection gap, I don't know, Gary, if you had some thoughts.
Thanks for the question, Mr. Birnbaum. As my favorite law school professor said, don't pretend to know the answer. So I will be careful how I answer, because I'm not sure I have thought through it totally. But my initial response, I guess, in line with what John was saying, data analytics, right? It is difficult at a division of insurance, like in Massachusetts or wherever, because you don't necessarily employ data scientists, right, to kind of unfold what some of the carriers may submit to us in attempts to, in efforts to you know, along loss mitigation. So my initial thought was we've tried hard with the industry in Massachusetts, I think in the United States generally, to understand better what goes into that data. I think with the help of people like Mr. Birnbaum and the consumer groups that have aided us in trying to figure out one, because in the end you don't want the consumer to be harmed, right? And so if the company is able to come in and share with us their information, and we may have to farm it out, some data scientists of our own to better understand, because we certainly don't want to put something into the market that is well intended, but in the end may harm a consumer. So it's not directly on point, but I will think about that a little further and see if I can.
John, if I could just clarify real quickly.
Sure.
When we look at innovations in vehicle safety, the auto manufacturers finance those safety innovations. They incorporate it into the cost of the vehicle. But when we look at resilience for properties, there's no property manufacturer that finances those. The individual consumer has to invest in resilience and loss mitigation. So how can we get the insurance industry to help finance those types of individual property investments in resilience?
And actually, I push back on you, Bernie, because the industry does a significant amount of financing and support for IBHS in the U.S., and it's the Twitter handle's @DisasterSafety. And if you see the work they do, my gosh, they test every shingle that goes on any home in the U.S. for those exact purposes of resilience. They just did a wonderful study on actually landscaping because after the California wildfires, are there more resilient landscaping materials that can be used? And the NAIC just partnered with the IBHS to take, I think, 30 insurance commissioners down to this demonstration to show that just how landscaping can change And so they have made a significant investment and then in making sure they're sharing that information with the marketplace. So I think that is one example. So it's a little different than the auto example that you made.
But I think, and to support that, John, I would say too that you're exactly right, and thank you for the reminder about those efforts. I mean, everyone in this room understands that you're spending $1 now is going to save. Research suggests $6 on the back end.
$6,
right? So we all understand that. So if there are other ways to accomplish this, I'm certainly all ears.
Manuela, did you have a comment
just
as well?
A last remark. I think whether this is a direct financing or maybe also indirect through other measures. For example, the insurance industry was instrumental in the building codes to make buildings more resilient against earthquakes. Another example, in France, you have for every household, you have now this kind of a map of the perils, where your apartment stands, and that is part also of your insurance policy. You get it handed out. So the pricing is also based on this, and depending on what you are doing and try to do, it could also help you with getting a better insurance product. And the third one is what I've seen in the future already linked to sustainable finance, and sustainable products is that houses that are insulated against warmth and cold, plus that have solar panels on the roof, sometimes are looked at differentiated in the prices. However, then there were others that said, okay, good look, but with the solar panels on the roof, I get a different property risk. So there are always two sides of the coin.
So I apologize. We're getting the hook. Connor has stood up. We get an ugly 0 here on our time. Things are going south here quickly. So if I had to summarize in Twitter fashion, hashtag protection gap, hashtag resilience, hashtag reinsurance, hashtag international markets, hashtag infrastructure, hashtag regulatory obstacles, and hashtag sustainable assets. That was your Twitter summary, Connor. Help me in thanking our panel members.